Hey guys, what is up? My name is Weston McKinley and welcome back to RWM Finance. Our mission here is to try and help everybody achieve financial freedom. So if you're wondering what I'm doing, I'm trying to fold some laundry. I'm a little bit behind on that, but I wanted to get this video in because I feel like it's kind of important, and a lot of people just, in the stock market, a lot of people feel like, they got to time the market the right way. And, everybody's heard the same saying whenever they start investing, buy low, sell high. And, that's what they've been told whenever they begin investing. So that's what they think they got to do. And yeah, this, it sounds like great advice, but it's very hard to put this into practice. It's like very difficult to actually do that. If investing was as easy as buying at the bottom and selling at the top before a crash, investors would no longer have an edge since the price would reflect the upcoming crash. Investors, economists, analysts, and all that, they've been saying that they're expecting a crash. They've been saying that they are expecting a crash since around 2013. And now 7 years later, they finally got what they were talking about. But I mean, at what cost did they miss out on certain investments because they were too scared to actually get into the market because they kept expecting a crash? Whenever 7 years later it finally came, but I mean, what did they miss out in that 7-year time span? Since 2013, the S&P 500 is up 120%. Even when the market did crash and dropped 30%, you would still be up 55% at the bottom of the crash and up 120% once the market recorrected. Take what the media and the economists and the analysts say with a grain of salt. Because yeah, they were right about the crash. It did eventually come 7 years later. However, they missed out on some crazy gains because they were too scared to get into the market because they were expecting this crash. So I mean, my point is that, don't be scared to get into the market. Don't try and time it up to buy whenever the market's down and then sell whenever it's, right before it's about to drop, right at the peak. Don't try to do that, because at the end of the day, that strategy doesn't really work that well. I mean, like those investors and analysts and economists said, they've been expecting that crash for 7 years, since 2013, and once it finally did come, they were considered correct. But I mean, there's no point in just sitting around waiting and expecting that crash. Yes, there are things that you should do before you get into the stock market. There are things that you need to do before you start investing. You should have an emergency fund. You should, try and be debt free or pay off your highest interest debt, or, you should have some cash on hand for that drop in the market. That way, whenever it does come, which you should still be in the market whenever it's coming, and whenever they're expecting it to come, you're in the market, you're investing, and then it comes. You have that cash on the side on hand. That way you can take advantage of that drop in the market and you can get those great companies at great prices. So my point with this video is to don't time the market. Do not time the market. What the heck? Sock in my pocket. There's no point in trying to time the market, because at the end of the day, time in the market beats timing the market, according to Peter Lynch. And Peter Lynch is one of the founders and of Merrill Lynch, the investment firm and all that. And I mean, he says that time in the market beats timing the market. So there's no point in trying to time it whenever you should just be in it. Dollar cost averaging is one of the main things that Warren Buffett says is a tool to help your investments grow. And you know how you use dollar cost averaging effectively? You stay in the market. You don't come out, you don't get in, come out, buy and sell. I mean, Warren Buffett's favorite holding period is forever. And a forever holding period allows you to take advantage of dollar cost averaging, compound interest, those types of tools. and it allows you to beat the market instead of timing the market. So I hope you guys got some stuff out of this video. I mean, it's pretty simple, you know. Make sure to get your stuff done before you get actually in the market and start investing, because there are some things that you should, you know, make sure you get done. But I mean, don't sit around trying to time the market, you know. Just get into it, get into the market, you know. Find some good stuff to buy, you know. Find a index fund, ETF, some good quality dividend paying stocks, and get in the market and stay in it. So I hope y'all got what you needed out of this video. If you liked it, if you enjoyed it, please scroll down, give it a like, and subscribe to the channel below. If you have any questions, comments, you know, just feel free to leave those down there. I respond to just about everything. Follow us on Instagram at RWM Finance. Make sure to check out the list of books in the description bar below. Remember that I post videos every Monday, Wednesday, and Friday, so make sure to tune back into the next one. As always, thank y'all for watching, and I will see y'all in the next video.